All right, let's do this. Mr. Mash here. Today we are going to look at derivatives with a specific focus on the federal funds features and the interest rate predictions. So basically we are going to try and understand what these federal funds features are and why they are used to predict interest rates and how. So we'll just give a background on this and how end of month activities affect the predictions of the interest rates. And also, we're also going to look at how you calculate the probability of an interest rate hike by the Federal Reserve. So I'm going to try and make this short. I hope you enjoy this. This is part of option strategies. Let's get right into this. Okay. So with the federal funds features and interest rate predictions, what's the big deal? What's the big deal here? Market participants, they want to know, they're interested. Remember, in the market, there are so many participants. People are buying, they're selling, people are borrowing money to invest, people are borrowing money to eat. So people are interested in the chances or the probability of the central bank changing the interest rates, either increasing it or decreasing it. What is the probability of that happening? If they can determine that, it's important for financial planning. The market reflects probabilities of those changes in interest rates. So the market is going to tell you whether or not there is a likelihood the rate will change. What are these probabilities? What is all this about implied probability? So the implied probability basically shows you what the market thinks is going to happen in the future. And these implied probabilities, they come from the federal funds features. They come from the federal fund features, giving you an impression of a perception of what is likely to happen. These may not always match the Fed's official statements like your forward guidance. But what are these Fed fund features? So when I say Fed, just know I'm referring to the federal funds features. What are these federal funds features? Your federal funds features are in agreement to buy or sell the average daily federal funds rate for a specific month in the future. You are basically making a bet on the direction in which the interest rate of the central bank or the Federal Reserve is going to move. You are simply betting on what the interest rate will be during a particular month in the future. And these Fed funds features contracts, they help predict the average interest rate for the federal funds. They provide a snapshot. They give you a picture of what the market expects to happen in the future. So they give you a snapshot of the future, what the market believes might happen or what the market expects to happen in the future. How do you get these predictions? So the predictions for futures contracts are tied to the effective federal funds rate. This effective federal funds rate is the rate at which depository institutions lend each other money. These are interbank rates. The rate that when banks borrow each other money or when borrow from each other or lend each other money, the rate at which they do that is called the effective federal funds rate. The market's pricing gives clues about the future average rate, not the Fed's target rate. So the market pricing is going to give you clues about the future average rate, okay, but not the targeted rate by the bank. In terms of end of month activities, towards the end of the month, activity is likely to increase, especially for large financial institutions. And when this activity increases, it may cause temporary dips or drops in effective federal funds rate. Remember, this effective federal fund rate. These are interdepository institutions rate, the rate at which depository institutions are lending each other money. And when there are these dips, these temporary, also remember, the dips are not permanent, they are temporary. They are going to introduce bias in probability calculations. So when the end of month activities cause these dips, you remember this relationship that the price of a financial asset is discounted. Hence, there is a negative relationship between the interest rate. So if the effective federal rates takes a dip, it drops. It means the prices are going to go up because it's at the denominator here. It's going to raise the prices. And so the end of month activity are going to raise contract prices. The effective federal funds rate is going to drop, and this is going to lower, it's going to reduce the probability of a rate change, which can affect prediction accuracy. To deal with these biases and these prediction accuracies affected by end of month activities, data providers will use smoothing techniques. You remember this from your quantitative techniques or statistics. Things like moving averages, exponential smoothing, seasonal removing seasonality. All of these techniques can be used to adjust the end of month dips and reduce bias. All right. In the short term, the implied probabilities, they tend to be more reliable. So they are more reliable in the short term as they reflect immediate market outlook. However, in the long run, these predictions usually lose power. So over the long term, they are going to lose power. Why? Because a lot of things happen in an economy. There can be a war somewhere. Putin invades Ukraine, and this has a huge impact on these interest rates. There can be a strike somewhere. So anything that happens in the economy, in the political arena, is going to have an effect. So market outlook can change rapidly, and external factors may introduce new uncertainties. Okay, let's crunch some numbers now. The federal funds features price, the federal fund features price is given by 100 minus the expected federal funds effective rate. So to make my life easier, I'm going to use theta for the expected federal funds effective rate. I'm going to use theta here. And if we take theta to the other side, the effective federal funds rate is going to be 100 minus the federal funds features price. That's how we get the expected effective Fed funds rate. Okay. And you must remember that to calculate this effective Fed funds rate, we use a weighted average formula of probabilities. Stay with me. This is the effective federal funds rate. We use a weighted average where we take the probability that the central bank is not going to hike the interest rate, and then we multiply this. So what the central bank does is it gives you the interest rate in a range, because you cannot know the future for sure. So they give you the interest rate in a range. You simply take that range given by the central bank and use the midpoint of the current rate. And then you add the probability that the central bank is actually going to hike the interest rate. Then you multiply by the midpoint of the new range when you have taken into account a change in certain number of basis points. Okay. And you remember, so this is actually very easy to remember. This is a weighted average. This is a weighted probability average. It's a weighted average. Probability that there's no hike, and you take the midpoint where there's no hike, the current range, and then you add the probability that there's a hike, then you multiply by the midpoint of the range where there's actually a hike. Okay. This probability of no hike, the sum of probabilities must add to 1. So the probability of no hike must just be the probability of 1 minus the probability that there's going to be a hike. So the effective federal funds rate is equals to 1 minus the probability that there's a hike multiplied by the midpoint of the current range plus the probability of a hike multiplied by the midpoint of the new range. So the effective federal funds rate is going to be the midpoint of the current range minus the probability of a hike times the midpoint of the current plus the probability of a hike times the midpoint of the new range. You take this to the other side. So your effective federal funds rate minus the midpoint of the current range must then be equal to, you factor out this. You have the midpoint of the new, because it's a positive here, minus the midpoint of the current. You factor out the probability of a hike. So the probability of a hike would then be equal to, you divide both sides by this. Probability of a hike is theta, the effective federal funds rate, minus the midpoint of the current range divided by the midpoint of the new range minus the midpoint of the current. If you want to change this to a percentage, you just multiply the answer you get here by 100%. Okay, so you need to remember this formula. If you forget things like I do, you can just use the weighted average. This is very easy to remember. Use the weighted average, then you calculate from the weighted average. But if you can remember this, which is also quite simple to remember, with exam pressure, you can easily forget and mix these numbers up. But the midpoint of the current range, both of them are subtracted. Both of them, at the top, you subtract the midpoint of the current range, and at the bottom, you subtract the midpoint of the current range. And then on top, you take the effective federal funds rate, and at the bottom, you take the midpoint of the new range. So this formula, very important. To conclude, some final thoughts. The implied probabilities are insightful, but they are not always right. Remember this, they are not always right. They are not a crystal ball. They are just a snapshot of what is expected in the future, but they are not a crystal ball. They don't give you cannot say with 100% certainty, especially over the long term. There might be good predictions for the short term, but in the long term, they may not predict accurately. So do not bet your farm on them. All right, do not bet your farm. I live in South Africa. I'm from Zim, and we have a party called the effective federal funds rate, the EFF, the comrades. So the comrades, this stands for Economic Freedom Fighters. That's the political party. And yeah, I just thought about it when I was looking at this EFF, effective federal funds rate. I was interchanging, saying Fed funds effective rate or effective federal funds rate is the same thing. So they are pushing for expropriation of land without compensation. They want to take the farms. But the suggestion would be, based on the implied probabilities, do not bet your farm. Don't lose your land over implied probabilities, because it might not go the way you predict. Okay, anyway, let's look at some exercises to wrap this up. I said this is going to be a short session. I hope, chances are I went more than 10 minutes, but learn, practice, improve. Let's do this. We're going to read these through three statements by Whitakers and see which of these statements is correct. Statement number one: typical end-of-month activity by large financial banking institutions often induces a dip. It does. In the effective federal funds rate, EFF. Yes, it causes a dip. And what does this dip do? What are the consequences of this dip? Because they might give you a different statement. This dip is going to result in a fall in interest rates. And this fall in interest rates is going to raise the futures contract prices, because there's an inverse relationship between interest rates and prices. So it will result in an increase in prices, and this results in lower probabilities. So it is going to result in lower implied probabilities, and it will introduce bias. To deal with this bias, data providers are going to use smoothing techniques like your moving average or exponential smoothing or seasonality. Okay, so the first one is definitely correct, resulting in a dip. Especially for longer term horizon, the probabilities inferred by the pricing for Fed futures usually have strong, never. In the long run, you can't bet your farm on this. So in the short term, yes, they may have strong prediction power, but there's a lot of uncertainty in the long term. So this is out. To derive probabilities of Federal Reserve interest rate actions, market participants look at the pricing of Fed funds futures, which are tied to the Federal Reserve's target. No. They are not tied to the Federal Reserve's target funds. They are actually tied to the effective Federal funds rate, which is a rate that depository institutions, let me just call it an interbank rate. Interbank rate, the rate at which depository institutions lend money amongst themselves. So this is not correct. It's not the Federal Reserve's target fund rate, it's the effective federal funds rate. So the only statement that is true here is statement number one. Done. If you manage to do this, well done. Let's look at the last one. You can read through this, but what's important is the current price for the Fed funds futures contract expiring after the Federal Open Market Committee meeting is 97.175. So remember, we said the Federal Fund futures contract price is 100 minus the implied effective federal funds rate, which therefore means that this implies that the effective federal fund rate is going to be 100 minus 97.175. You calculate this, you should get an answer of, what's the answer here? 2.825%. And then the current federal funds rate target range is between this is the current range, and they explain how KO can use this information to understand potential movements in the federal funds rate. Calculate the probability of an increase of 25 basis points in the target range. So our target range is this one, right? So the current target range is from 2.5 to 2.75, and we want the midpoint here. So the midpoint of the current rate is 2.5 plus 2.75 divided by 2. That's how you calculate the midpoint, and you should get 2.625. If it increases by 25 basis points, 25 basis points are equals to 0.25%. So the new target range would then be, you add 25%, 0.25 here, 25 basis points, and you're going to have 2.75, and this is going to go, if you add 0.25 here, you're going to get 3. This is the new range, and the midpoint of the new range is 2.75 plus 3 divided by 2, and you should get an answer of 2.875. All right. The quickest way to do this is just to remember the formula. And I know because you guys are smart, you remember the formula. And if you're not so smart and a bit slow like me, you just might want to take this weighted average, where there's a probability of no hike times the midpoint of the current plus probability of a hike times the midpoint of the new. This is basically, if from here, this is 1 minus pH, right? So the 1 minus pH, if you make the Pn the subject of the formula, Pn, its pH would then equal to this new, this effective federal funds rate minus this one, the current, over the new midpoint of the new minus the midpoint of the current. This is the formula that you get, right? If you simplify this by just saying theta equals 1 minus the probability of that hike times MC plus pH times Mn, and then you solve this, you make this probability of a hike the subject. Our theta is here 2.825 minus the MC, the midpoint of the current, 2.625. You divide this by the midpoint of the new, 2.875, minus, we take this number again, 2.625, multiply this by 100%. Punch these numbers into your calculator. You get 0.2 over 0.25 times 100%. Hence, the probability that the central bank is going to hike the interest rate by 25 basis points is 80%. Okay, so I hope you know how to calculate. If you remember this formula, just use it. Yeah, it's just that you are expected to know too many formulas. But as I promised that this session is going to be short, my job is done here. I hope you guys are enjoying getting to learn capital markets. And I know sometimes it can be frustrating, sometimes you enjoy it. It's a roller coaster, but keep calm. Keep calm and practice. Practice. Mr. Mash is out. I'll see you guys in the next one. Peace.